My name, if you do not know me, is Eric Shirley. I am the Director of Acquisitions here at Four Oaks Capital, and we are super excited to be sharing our latest and greatest acquisition opportunity with you guys. This is for Southern Oaks Apartments in Stone Mountain, Georgia. The way this is going to work, we're going to run through the investment packet. We're going to talk about the opportunity, talk a little bit about who we are and how this all works. We're going to walk through the underwriting, talk about the market itself in Atlanta, talk a little bit about why we love this project. And then at the very end, we'll have some time for questions and answers. So if you do have questions, please type them in the chat box. Brian's going to keep them logged. If there's an appropriate time for him to jump in and ask the question, he will do so. If not, we will address them all at the very end. But without further ado, we're going to get started here. So by law, we have to let everyone know this is a prospectus for an investment, and we are trying to show you guys what we're working on. And this is an active investment opportunity. So that's my legal disclaimer. But this is one of my favorite quotes. I'm a huge Warren Buffett fan. For those of you that know me, I talk about Warren all the time. But Warren Buffett's a huge believer in real estate. If you don't find a way to make money while you sleep, you'll work until you die. That's one of the reasons we love real estate so much, is it presents an opportunity for mailbox money. And that's what we're all ultimately looking for, is a way to grow our wealth in secondary ways to our primary income, and just collect a check each month. That's what it's all about. So we are Four Oaks Capital. Four Oaks, these are the four primary members. Myself, I'm the Director of Acquisitions, and I run our acquisitions team. Kelsey Bailey runs one of our sister programs. It's called Cash Flow Concierge, just for high net worth individuals looking to buy their own individual assets. And she's doing a great job over there. Brian handles all of our investor management and investment management. So he works hand in hand with our property management companies, manages the properties. We just have a couple properties that are smaller that we do self-manage. And then Brian is kind of your primary conduit as an investor. He's the one when you sign up for the investor portal. He sends out all that good stuff. Brian also helps with a lot of our marketing. And last but not least is Kranti Panam. Kranti is our Director of Capital. He works a lot with the financial side and the money raising. And Kranti's an integral part of this foursome as well. So let's kind of dive into it. This investment offering, it's 165 units. It's 2 contiguous properties. Side by side, you have Southern Oaks, the primary building or the primary original development. And then right next door is Southern Oaks 2. And they are literally side by side and share a pool. They were both built in 1971. Purchase price for this is $18.81 million. That works out to be right at $114,000 a door. And we'll dive into some of this a little bit later in more detail as to why we like this opportunity. But we feel like at $114,000 a door, this is an absolute steal in the Atlanta market. The total capital raise that we're looking to bring in from our investors is just over $9.6 million. The returns is a total return of 53% on the investment, so a 1.53 equity multiple. That works out on a 3-year hold to be a 17.7% average annual return and a 15.6% IRR. For those of you that are not familiar with internal rate of return, it's very similar to your average annual return. It just factors in the time value of money. And that's why it's slightly lower, because $1 today is worth more than $1 in 3 years due to inflation. As I mentioned earlier, the investment period is 3 years. That is our projected investment window. We have up to 5 years due to our loan terms, but we are looking to divest of this property in 3 years or sooner if the opportunity presents itself and it makes the most sense for you, the investors. For our returning investors, thank you for joining us. We appreciate your continued support. Minimum investment for returning investors is $50,000. A minimum investment for all new investors is $100,000. And cost segregation. This is something we like to toss in. We never factor in cost segregation into our quoted returns, but cost segregation can be a huge beneficial thing when you look at the depreciation that you get to apply to your taxable income. I am not an accountant. I cannot give accounting advice, says our legal team. But I can tell you that cost segregation is a powerful tool. And based on the cost seg study and the preliminary overview from our cost seg consultants, It's going to be about a $25,000 cost or depreciation passed along to an investor in the first year on a $100,000 investment. So that's pretty darn strong. So this is Southern Oaks. This first picture you see here on the left, that's the first phase. And the second picture on the right that has the red around the windows, that's the second phase. Southern Oaks is located in Atlanta, Georgia. We are so bullish on this market to the point, and we're going to touch on this in just a second, but the partners at Four Oaks have personally bought 3 assets in Atlanta, just over 300 doors in the last 6 months. With this investment, we will have just under 500 doors in Atlanta itself in the last 6 months. We are super bullish on this market, and we'll touch on some of the reasons why, but I think you'll very quickly see why Atlanta is one of the most prolific hotbeds in the southeastern United States for multifamily. So I just mentioned recent acquisitions. We own the Commons in Camp Creek. That's in College Park, right near the airport. That's 124 units. We closed on that about 5 months ago. Just to toot our horn slightly on that, when we purchased that property 5 months ago, the monthly revenue was at $80,000. In month 4, we crossed $120,000 in revenue for the month. And month 5, which we just closed out, we also crossed $120,000 in revenue. Our property management team in Atlanta is second to none. They're absolutely fantastic. And we've seen a $40,000 increase in monthly revenue just in the first 4 to 5 months alone with that property, which is incredible. We own Vesta Gardens, which we just closed last month. That's also in College Park. That's 88 units. And then Prosper Point, which is just on the other side of College Park, right near the airport. That's 108 units. And that's closed as well. So we have some awesome things happening in Atlanta. As you can see, we're super stoked about this market. We have this awesome video Brian sent out. I don't know if you guys have had a chance to look at it. I'm not going to play it right now just for the sake of time, but Atlanta is booming. And there's some key statistics I always like to talk about with Atlanta right now with what's going on. In the last calendar year, Atlanta's seen 170,000 new jobs, which is absolutely incredible and speaks to the growth of the marketplace. Rivian, who's one of the largest electric vehicle manufacturers in the country, just committed to build a $4 billion facility in South Atlanta. It's going to create 10,000 new jobs. Tyler Perry just finished a monstrous new movie studio right on the south side of Atlanta. So you've got 18% rent growth year over year. That's incredible. 18% growth in rent in just the past 12 months alone. If you look at the MSA of Atlanta, which is a metropolitan statistical area, that encompasses downtown Atlanta and all of the subsidiary submarkets of Atlanta. Atlanta has a 96% occupancy rate across all multifamily apartments, 96% occupancy on average. That's incredible. That means the demand for multifamily is astronomical. On top of that, 31% of the population in Atlanta rents. So you've got growing rents, you've got a supply shortage and a high demand for apartments, and you've got extremely high occupancy, which is incredible. And this just speaks to that. It just continues to grow and boom. And this is a great stat right here I want to hype on. The population growth through 2050 in Atlanta is equivalent to the entire Denver metro area moving there over the next 20 years. Guys, that's incredible. That just speaks to everything that's happening in this market. 26,000 jobs added in June alone. 29 Fortune 1000 companies call Atlanta home. I'm sure everybody knows Atlanta has the busiest airport in the world. It's the largest employer in Atlanta, 65,000 people, and offers 2-hour flights to roughly 80% of the US population. That is a huge economic driver in this market, Delta being one of the primary sources of that. And just a fun fact that we thought was cool. The airport was originally a racetrack that was owned by Coca-Cola founder Asa Chandler. So just a neat thing. But we're super bullish on this market. And I've already spoken to some of this, so I'm going to push through these fairly quickly. But it's just growing by leaps and bounds. There's a tremendous migration from the Northeast sector, New Jersey, New York and Connecticut, Pennsylvania. There's a huge migration down to the Southeast. And the primary reason for that is the cost of living is much cheaper. Property taxes are much lower. and you can get a lot more bang for your buck, basically. There's also tremendous incentivization throughout the Southeast, specifically in Georgia as well. Georgia is incentivizing companies through massive tax benefits to move to Georgia. And so we're actually seeing a tremendous amount of the tech sector leaving California because of the high cost of ownership in California and moving to both Texas, Atlanta, and Raleigh-Durham. So Raleigh obviously being in the Southeast as well. So Atlanta is a hotbed for that. So it's a young population. Median age in Atlanta is 37. That bodes extremely well. 67% of the workers are white collar, and you can see a tremendous amount of net migration being projected. In 2022, Atlanta's unemployment dropped below 3%. So Atlanta currently has unemployment rate at 2.9%. That speaks volumes to the amount of employment that's being created in this market. So you might be asking, we're talking a lot about Atlanta, and why do you keep throwing out these numbers? These are all the huge economic indicators that show prolonged growth and prolonged sustainability when you're looking at a multifamily asset. When 31% of the population of this city rents, that's 1/3, 1 out of every 3 people rents. There's a huge housing demand and a supply shortage. When you have, excuse me, when you have that kind of correlation between supply and demand, it allows the ability to push rent significantly because there's such demand for the product. If you have a surplus of property that's uninhabited, then you aren't able to achieve that same level of rent growth. Employment trends, I spoke earlier about about Delta being a primary driver. 34,000 employees in Delta, 32,000 at Emory University, and the healthcare system that Emory provides. You can see the remaining list. One of the things I love about Atlanta, and one of the things we look for in a market, is we don't like any one sector of the employment sector to be within one area. So you can see the diversity down here between employment. What happens when you have more than 25% in one economic sector, you get what happened in Detroit. The car industry went not belly up, but started moving out of Detroit. And that's what the entire population was based on economically. It was the biggest key driver, and Detroit just fell apart. So we really look for places with great diversity of employment, and Atlanta checks that box. Obviously, the airport is a huge, huge aspect of what Atlanta has and is a tremendous impact on that economy. We've been through the multifamily outlook and all of these graphs over here on the left, these just speak to everything I've already said. There's tremendous demand. The absorption is happening faster than new construction can come to the market. You can see the rent trends, tremendous year-over-year growth, and sales trends. Cap rates have dropped and purchase prices have risen, which is always a good thing when you find an undervalued asset that you're getting a steal for, because you know you're going to be able to sell it at a tremendous premium in the future. So these are all the trends that we want to see moving up in a consistent trajectory. Atlanta is home to a ton of higher education. There's 275,000 undergrad students in Atlanta, and that's comprised over 66 universities and colleges. Georgia State is actually the biggest university in Atlanta. Georgia State is the 5th largest college in North America, has over 50,000 students alone. So let's talk about the property itself. Southern Oaks is in a tremendous spot. It has very easy access to US 78 and I-10, which are 2 of the key thoroughfares to get to the downtown area. It's only about 15 minutes from downtown, so it's easily commutable. And we've all been to the property amongst the Four Oaks team, and it's just located in a really cool area. It's located right around a mile from Stone Mountain National Park, which is the largest tourist attraction in the state of Georgia. It's the most frequented by visitors. In addition to that, there is actually foliage. And that might sound silly, but when you're in a metropolitan area like Atlanta, it's really nice to be able to find a property that has some lush greenery surrounding it, because you don't feel like you're in that super tightly compacted urban sprawl, if you will. So let's talk about Stone Mountain. Stone Mountain is a small little submarket in Atlanta. It is one of the faster growing sections of Atlanta. And the reason is it was undervalued. It was not one of the cool, trendy areas at the time. And now there's a lot of money starting to pour into Stone Mountain. And what they're doing in that little downtown Stone Mountain area is really pretty fantastic. They're trying to catch up to the Decaturs and the some of the other more kind of hipstery, uppity areas. They're starting to get some of the breweries and some of the neat little kind of pub areas and some great little shopping areas as well. Again, we have a really cool video that highlights some of the things in Stone Mountain that we sent out to everyone. But I think it's access to the to transportation and to the interstate system to be able to get to Atlanta, to get to the airport. We flew in, gosh, 3 weeks ago to start the due diligence process. And we made it from the airport to this property in just over 25 minutes. And that was at 8:30 in the morning. So it really is conveniently located and close to pretty much everything that you would need. Some of the big popular nearby attractions are the Sky Hike, Stone Mountain Park, which I alluded to earlier, Stonecrest Mall, which is starting to get some of the higher end shopping venues, and several breweries and restaurants, which I mentioned as well earlier. So let's talk about this asset specifically, Southern Oaks. As I mentioned earlier, it's 165 units, and it's broken down. It's 81 bedrooms, 84 2-bedrooms, and 1 3-bedroom. The reason we have these 1-bedrooms split here is because of the first section, Southern Oaks, the original section, and then Southern Oaks 2, the secondary section. That's how we're trying to split it up. So 56 1-bed, 1-bath that are 800 square feet, which is a very nice 1-bedroom, 1-bath in Atlanta. That's a very large unit. 24 1-bed, 1-bath that are 850 square feet. You've got 84 2-bed, 1-bath that are 950 square feet. And there's 1 single 3-bedroom, 1-bath that's 1,100 square feet. I've been asked several times, why is there only 1 3-bedroom? It was a 2-bedroom that was added onto because the original owners of the property lived in that specific unit and needed a little more space. As I mentioned earlier, Southern Oaks is comprised of 2 contiguous neighboring properties. It was constructed in 1971 in brick, which we love brick assets. It's on 10 acres, and it is very close to that downtown area that is really starting to catch on and catch some momentum. So there's been a nice capital infusion in this property already. 80% of the roofs have been replaced in the past 5 years, which leaves 6 roofs that need to be replaced. We've already gotten quotes, and one of the first things we're going to do upon takeover is replace the remaining 6 roofs that have not been replaced. The parking lot was very recently sealed and striped. It looks fantastic, and there is a significant amount of parking. We own a lot of assets throughout the Southeast, and per unit, this has more parking spaces per unit than any other asset that we own. There are several on-site amenities, including a playground, a swimming pool. It is pet friendly. There is a laundry facility with 24-hour access. They built a brand new leasing office. Gosh, they just finished it about 3 months ago. And that's really cool because the leasing office previously was in a unit. So now we can convert that unit that was a leasing office into an inhabitable unit. That should generate roughly $12,000 to $15,000 in additional NOI per year, which at a 5 cap is about $300,000 in additional value just by converting that leasing office into an occupiable and inhabitable unit. The new leasing office is beautiful. They have LVP flooring, granite countertops. It just looks clean, fresh, and modern. I think we have some great pictures in the deck as well of that. There is full-time on-site management and maintenance. The plan will be a full-time property manager, a leasing agent that's part-time, a full-time maintenance supervisor, and then a full-time maintenance technician. So we will be well covered with on-site personnel. And then MARTA, which is one of the largest public transportation systems in Atlanta. It has a bus stop directly at the entrance to the property, which is super convenient access for those folks that do ride the bus that are at the property. So this is a picture. They have renovated about 10 of the 165 units. And this is a picture of some of the renovated units, which look really nice. They're doing faux granite countertops, shaker doors, black appliances, LVP and carpet. So they've really done a nice job. And we'll touch more on what they're achieving as far as rent bumps with their renovated units on new leases right now as we speak. So these are the layouts. This is the 800 square foot 1-bedroom. You can see it's a nice open concept floor plan. This is the 850 square foot bedroom. There's a ton of closet space, which is always a perk. We have our 2-bedroom layout right here. And last but not least, the single 3-bedroom layout. So let's talk about the business plan. What are we trying to achieve here? What are the goals? So our primary business plan is to do interior and exterior upgrades. And we're going to go through the specifics in the CapEx here momentarily. But if we can improve these interiors and really give it nice curb appeal from the outside, it's really going to be able to help us attract a higher caliber of tenant. And with a higher caliber of tenant, it enhances our ability to push these rents the way we want to push them. We traditionally spread our interior renovations over a 3-year period. We try to do 35% roughly in year 1, 35% in year 2, and 30% in year 3. That's what we've pretty much done across the board with all of our assets, and this is no different. What is most important to us as we're renovating units is maintaining a high level of occupancy and keeping the revenue coming. So how do we do that? We start with vacant units. Right now, there's about 10 current vacant units, and the goal is to get in very quickly, renovate those 10 units, and then we're going to offer them to the current tenant basis first. We're going to say, hey, your rent is going to go up when it comes time for renewal. So we're going to go ahead and give the first 10 people that want to the opportunity to move into these 10 freshly renovated units at the current market rents, which is what our 3-year rent goals are. We've had great success with this at our other properties. Those 10 tenants will vacate the current units that they're in, move into the fully renovated units, and then that leaves us 10 more vacant units that we can wash, rinse, and repeat. We do this cycle until we don't have any more tenants that want to move into renovated units, which is fine as well. When they come to renew their lease, one of 2 things happens. They either pay a significant premium to what they were currently paying to live in an unrenovated unit, because we can't renovate that unit while they're staying in there, or they move out, and that's okay too. We work with our property management company every month to see what units are coming available as far as move-outs and renewals, and we start looking at that about 3 months in advance. So that way we know how hard we can push tenants and the rent increases for those tenants that don't want to move into these newly renovated units. And guys, if I'm talking a lot or talking fast, I apologize. I'm fired up about this property. I love multifamily real estate. And when I get excited, I talk fast, so I apologize. Let's talk a little bit about our property management team. Seams is our property management team, Southeastern Asset Management Services. Seams is awesome. We found these guys through a broker recommendation when we really started kind of dipping our toe into the Atlanta market. They manage all of our assets in Atlanta. As I mentioned earlier, they're doing a fantastic job. In the property that we bought about 5 months ago, we're already seeing revenue increases of $40,000 a month. Also in that same property, we have 100% pre-leased units and 96% current physical occupancy, which is fantastic. You really can't ask for much better than that. I'm not going to read kind of their mission statement, but I can tell you that one of the reasons we like Seams too is they are a boutique firm. They are not looking to become a firm that's going to manage 30,000 units in Atlanta. Their sweet spot is 3,000 to 5,000 units. They work with us and 3 other companies, and they're at about that 2,500 to 3,000 unit mark right now. And with what we plan to do in Atlanta over the next six to 12 months, they'll be comfortably in that 3,000 unit range, which is their sweet spot. We love the fact that they're a boutique firm because we are a big fish in a small pond. We get the attention we need, and we're able to meet with them regularly. We like to meet with them at least once a week. When we take over a property, we typically meet with them 2 to 3 times a week for the first 4 to 6 months, and then slowly taper that off as we see that the business plan is being successfully executed. So let's get into what are we actually going to do to this property. So we have a $2 million renovation budget. The bulk of that is going towards the interiors, $1.4 million on the interiors. That's about $8,000 a door. So what do we plan to do with that $8,000 a unit? We're going to replace all the flooring. It's going to be, depending on whether it's a first floor, second floor, or third floor. First floor units will have LVP flooring throughout. Second and third floor will have LVP flooring in the common areas and carpet in the bedrooms. Faux granite countertops in the kitchens and bathrooms. Stainless steel appliances, we're going to upgrade from the black all the way up to the stainless, as well as a backsplash. The backsplash is a very inexpensive thing that we can do that gives it a very rich modern feel. We always like to do modern paint schemes, whether that's having an accent wall or even putting in chair railing in the dens to give a two-tone look. We upgrade the lighting packages. We add ceiling fans to all bedrooms and all common areas. That, again, might sound like a small thing, but we have found that our residents absolutely love having a ceiling fan. It allows them to not have to use the AC as much, which reduces their electric bill. We put 2-inch faux wood blinds throughout. Let's see here. Kitchens, we're going to do the shaker cabinets with new hardware. We use a company called Cinch Kit. So we walked all 165 units. We did not find a single unit where the boxes, the cabinet boxes, were not salvageable. So we will keep the existing salvageable cabinet boxes. And we use this company called Cinch Kit, and they manufacture solid wood shaker doors and provide all the hardware to give it that upgraded modern look. We'll upgrade the bathrooms with new vanities, and then we're going to reseal all of the tubs that require that. So it's basically a complete interior overhaul. Interiors, we're looking at about a $600,000 budget. We're going to do, so I don't know if you remember the original picture, but it has that kind of reddish brownish brick on a large part of the exterior. So we're going to go around, we're going to paint all of the brick. We're going to add shutters. Anywhere where there's currently siding, we're going to replace that with a high-grade vinyl siding. We really like, it's called modern gray, but we really like to use gray. It just makes the property look a lot newer and makes it have a much more modern and updated feel. As I mentioned, we're doing new shutters. We're going to finish the roofs that have not been replaced. We are going to need to repair and repaint some of the metal exterior stairs in the original phase of the Southern Oaks development. Most of them are in relatively good shape, but they need to be sandblasted and then repainted with a fresh coat of paint to really make them pop and add to the rest of the exterior touches that we're doing. Landscaping is a huge opportunity here. They have pockets where the landscaping really looks nice. It's fresh, it's clean, it's bright, and that's what we want. But that is not consistent throughout the property. So we're going to do a nice landscaping overhaul and really make the property have that wow factor as soon as you walk on. Then we're going to do new signage. That's going to be signage that is for each building, as well as the main entrance signage, which is going to be really nice. And we have a great sign company that we've used for all of our other assets. They're willing to come to Atlanta for us from Greenville, South Carolina, and they just do a jam up job. We like to do signage that it has kind of a wooden looking background with backlit LED backlit letters, and it just looks absolutely fantastic. So we have some amazing partnerships with local contractors in Atlanta. They've done a ton of CapEx to our existing assets in Atlanta. We've already had them out to quote it. We've had a GC, a plumber, an electrician, a landscaper, and they all work under the same primary guy. It's A to Z renovations, and they literally do everything from roofing to plumbing, interior renovations, fences, decks. They are a one-stop shop. They are very, very reasonably priced, which is hard to find in today's market. They do very high quality work, and they do it in a very expedient fashion. I've always heard the things, if you can have it good, you can have it cheap, or you can have it fast, but you can't have all three. These guys have actually defied that statement, and we've been extremely impressed with what they've done at our other properties so far. So we fully intend to use them here. So let's talk about rent comps. There were some rent comps in the packet. Those are about a year old. Those came from the broker's opinion of value. So what that means is when the brokers first talked to this seller that we're buying from, they were starting conversations of whether they want to sell or not. So the broker goes around and pulls together all this information and says, we think your property is worth XYZ. At the time, it was $128,000 a door. Keep in mind, we have it under contract for $114,000 a door. So some of those rent comps are slightly dated. This is the rent comp I really want to focus on. Willow Lake is a property directly across the street. I've got a better picture of the map in a few slides that I'll show you. When I say directly across the street, I mean, you can throw a football from Southern Oaks, you could throw it through a window across West Mountain Drive into Willow Lake. Willow Lake was also built in 1971, so they were the same vintage property. It's a little larger as far as unit count. They have about 250 units. This is 165. But you can see that they're already achieving one-bedroom rents, and I know this is small and I apologize, but one-bedroom rents between basically $1,200 and $1,500. Two-bedroom rents down here between $1,100 and $1,500. The 1,100 unit, $1,100 a month, two bedrooms are unrenovated. And then the three bedrooms are going for basically $1,500 to $1,750. This is just such a great comp for us because of the proximity to our properties. So I'm going to scroll through these other properties because those numbers are outdated. So let's talk about sales summary. Sales comp include two 1970s assets within 2 miles. The first one is Willow Creek, and you can see the proximity. Here's Southern Oaks down here. Here's Willow Creek up here. It's literally right across the street. Willow Creek sold 3 months ago for $155,000 a door. We have Southern Oaks under contract for $114,000 a door. The reason we got this for such a steal is the current ownership group that has it now ran out of money. They've only owned it for about a year. They were grossly undercapitalized, and you can't raise rents if you don't have the money to improve the interiors and the exteriors. That's just a fact. They had it under contract about 5 months ago for $128,000 a door. That deal fell through because, as many of you know, the interest rates have gone up. When the interest rates go up, it causes purchase prices to come down slightly. There was not a bank that would lend on this property at $128,000 a door. The broker, when that deal fell out of contract, called us, said, I know you guys have bought 3 properties in the surrounding area relatively recently. Would you like to take a look at this? We said yes, we fell in love with it, and we put it under contract within a week. But if you look at this, $41,000 of built-in instant equity. I can't stress that enough. $41,000 per door over 165 units. That's incredible. That means there's tremendous upside and value in this property. I didn't touch on this. About 1.5 miles away, another 1970s vintage property sold for $190,000 a door. That means we are getting a diamond in the rough, which is fantastic. So let's talk about why do we like this investment? What made us so excited about it? Why do we put it under contract so quickly? Why are we so bullish on Atlanta in general? Southern Oaks is in the Stone Mountain submarket. We talked about how amazing Atlanta is right now, all the key economic indicators we look for. It's only about 15 minutes from that downtown Atlanta metro, which is amazing. It's the corridors as far as interstates. It has easy access to those so people can get in and out very, very quickly. It's 165 units with an equal mix of 1 and 2 bedrooms. And all of those units have generous square footage and really nice open floor plans and layouts, which is great. Currently, the rents trail competitive properties by almost $500. That means we can get in, we can execute our renovation plan, and we can raise those rents significantly. Those increased rents are just going to drive that purchase price up significantly higher, and we already have that rent comp at $155,000 a door, which is amazing. The Stone Mountain submarket has an average occupancy exceeding 96%. That means there's high demand in this submarket and has year-over-year rent growth of 18%. It's actually 18.8% over the last 12 months in Stone Mountain specifically. And as I alluded to earlier, the demand for apartments is extremely high. Stabilized, renovated apartments all have wait lists, which is what you want to see in the market that you're looking to invest in. So let's talk about the underwriting specifically. For those of you that are new to multifamily, what we like to do is show you our 3-year pro forma so we can walk through line by line. Most of these numbers, as far as expenses, come directly from the trailing 12-month expenses. So we actually have access to the current ownership as it stands now, their last 12 months of financials. So we're able to see exactly what they're spending on the expense side, and we know what our plan is to push rents on the revenue side. So let's walk through that. Current rents at this property are right around $900. They've actually gone up in the last 3 months to about $930 on average. We're going to be pushing rents over the first year to an average of $1,050 across the board. What does that mean? That means we're pushing the 1-bedroom rents to about $1,250. We're pushing the 2-bedroom rents to about $1,425, and the 3-bedroom we're going to push to $1,525. So we're going to average year 1, $1,050 in average rent, year 2, $1,200, year 3, $1,350. That is still below what Willow Creek across the way. That's below what they're getting today. Our three-year rent projections are. The last 3 leases or 4 leases that they've signed at Southern Oaks are already at these 3-year rent numbers. That means they already have proof of concept that those numbers are achievable, and they're not getting any pushback in renting vacant apartments at those higher rent rates. So vacancy, currently they have 10 vacant units. 10 vacant units works out to be about 7% vacancy. The only reason that those units are still vacant is because we have asked the current ownership to keep them vacant. We want vacancies. We do not want them signing or filling up all the new vacant units with tenants, because we want to be able to vet the tenants and put the type of tenant we want in. And we need those vacant units to be able to turn them and renovate them to our standard. Year 1, we have a 7% physical vacancy. Year 2, 5%, or excuse me, year 1, 7% physical vacancy and 5% bad debt. The current bad debt is hovering around 3.5%. That's going to taper off in year 2, or excuse me, we're keeping that the same in year 2, 7% physical vacancy, 5% economic vacancy. And then in year 3, that tapers down to 6 and 4. Most of these properties throughout this submarket, again, are averaging 96% occupancy. We're factoring in 10% vacancy, which is 90% occupancy. That means we have a huge cushion to play with in our numbers. We fully expect to outperform those numbers, but that's what we're underwriting just to be hyper conservative. RUBS income, we're going to implement a bill back. Currently, they are billing back for water, but at a grossly reduced rate compared to what everything else in this submarket is doing. So we're going to implement a RUBS. That means currently the tenant pays for the electricity and a small portion of the water. We are going to be billing the tenant for the water and sewer, trash, pest control, and an amenities fee. So that is where that money is going to come from. And you can see $100,000 in year 1, and that's going to gradually grow over the 3 years. Other income. Other income includes everything from pet rent, application fees, late fees, laundry income, damage recoupment. So if someone, if the TV puts a hole in the wall, say the TV falls and the corner of the TV goes through the wall, we charge the tenant to replace that. That's money that we're able to recoup. Blinds, if blinds get damaged, it's the tenant's responsibility. We replace them, but then we bill it for them. All of that falls under other income. In year 1, that puts us just shy of $2 million in total revenue. Year 2, we're at right around 2.3 million, and at 2.6 million in year 3. We feel like those are very conservative numbers and fully believe that we can outperform those numbers on the revenue side. On the expense side, advertising. So we budgeted $10,000 for an advertising budget. I don't think we're going to need it. The vast majority of the current tenant base is found through literally Craigslist and apartments.com and Facebook Marketplace. Those 3 things. Apartments.com costs about $350 to $400 a month. That's about a $5,000 annual budget. We wanted to build a little bit more in case we wanted to run targeted Google ads for folks looking for apartments in Atlanta. Contract services. Contract services are your pest control and your landscaping. So those are monthly service contracts where they come out on a regular basis to take care of that. That number is right in line with the current expenses that the current ownership pays. And that's coming, and those are contracts that we are assuming moving forward. Gas and electric. Again, this is coming from the trailing 12-month expenses. Really, the only gas and electric that we are responsible for is the clubhouse or the leasing office, and then any vacant units, and then common area lighting. So there's not a ton of gas and electric that we are responsible for on the management side. Insurance, general and admin. So general admin, we have actually increased that from what the previous ownership group had. We bumped that up about 10% from what they were modeling. That includes copier leases, business licenses. We're big in community involvement. So we like to do things like back to school drives where we supply backpacks with notebooks and pencils for all the children that are residents. We like to do a pizza party once a month for the current tenant base, like a pizza and a movie night. That would fall under there as well. Insurance. Our original quote from insurance came back at $115,000 annually. That is a little bit on the high end. We do think we can get that down. There was a fire at the original Southern Oaks that burned 4 units. That happened about, gosh, it's been almost a year now. Those 4 units are currently in the process of being renovated through the insurance claim that was filed. And they're going to be immaculate when they're done, brand new, freshly renovated. And those will be done ideally by the time we close or shortly after we close at no cost to us, which is lovely. But because of that fire, that did drive up the insurance premium slightly, even though it's not under our tutelage. Real estate taxes. So the real estate taxes, it's really interesting how Atlanta works. So you can actually appeal your insurance, and we've already procured the company that will do this. They've done this for our other 3 assets. They appeal it. You're typically able to get 80% of the value of the property, and that's how they assess to get your taxable value. And then you can lock that in for 3 years. So the taxes are going to go up to about $365,000, but they will be locked in. So they will not go up over our whole period, which is great. Anytime we can have an expense that's fixed or we don't have to guess, that's fantastic. Trash removal, we do have a trash contract that we are assuming that comes out and picks up the dumpsters that are located strategically throughout the property. The management fee, Seams charges a 3% management fee to oversee the on-site personnel and execute the business plan. They are worth every penny, and typically it's between 3 and 4% is the management fee. When we first started with Seams, it was 3.5%. Because of the volume that we've brought them over the past 6 months, we've been able to negotiate that down to 3%. Payroll, $171,000 a year. That $171,000 will cover the salary for the property manager and the maintenance supervisor, and then the hourly wages for the maintenance tech, as well as the part-time leasing agent. Repairs and maintenance. It's about $500 a door, which makes it about $82,000 a year. The reason that this number is what it is because we are dumping a tremendous amount of capital into the property on the CapEx side to do renovations. If we are fully renovating interiors, there should be very little repairs and maintenance that need to be attributed to those renovated units. We budget $500 for all of our properties, and we are consistently at or below budget across the board with the rest of our portfolio. So we believe that to be a very healthy number for this property. Water and sewer. One of the things that we're going to do when we do the interior renovations is we are going to put low flow faucets and low flow shower heads. That should help bring this water bill down. This $152,000 is right in line with what the previous 12 months water bills has been, but we feel confident we can bring it down. We wanted to be conservative and budget it with how it's been over the past 12 months. But those low flow, in our experience, low flow faucets and low flow shower heads can drastically reduce the water bill. One of the other things that we're going to do is the exteriors of some of the buildings have spigots. We're going to have those spigots removed and capped. What happens sometimes is the tenants will go, we had a situation at another property that we found out the hard way, but that was basically running a weekend car wash business on our water dime. So by capping off those spigots, we don't have to worry about that. Deposit to replacement reserve. This $41,000 here, and excuse my French, but we kind of call this our oh shit fund. Each year we like to put some money to the side for things that we were not expecting. Whether that's a higher number of HVACs need to be replaced in that year, whether it was a sewer leak that we weren't expecting. We have had all the plumbing looked at and the plumbing is in good shape, but things happen. Property was built in 1971. That means it's 51 years old. Stuff is going to come up. So every year we like to put around this $40,000 mark, just in kind of a rainy day fund for when we need it. It's always better to have that money set to the side than not have it when you need it. That brings our total expenses in the first year to just over $1.1 million, just shy of $7,000 a unit, which is a very, very healthy amount on the expense side. Again, very, very conservative. 56% expense ratio in year one. That drops to 50% in year two and 45% in year three. So while our expenses are not changing drastically, because of the revenue that we're generating, as it increases, it's going to bring our expense ratio down to where it really should be, which is in that mid 40% range. And that's what we're seeing at our other assets as well. Our debt service. We have procured a bridge loan through Santander Bank out of New York. A bridge loan means we have a 3-year term with 2 1-year extensions. It is a fixed rate bridge product. The reason we like a bridge product is because it greatly reduces the prepayment penalty that you have to pay if you have a permanent debt option in place. I don't want to get into the weeds on debt and how this all works, but we were able to lock in our rate. Looks like we're going to be locked in. We'll find out officially tomorrow, but right around that 5.3 mark, which is a great fixed rate for a bridge product because we don't have to worry about a ton of origination fees. It's only a 1% origination fee on the front end and a minimal prepayment penalty on the back end. So what does that mean when all is said and done? This is the amount of cash flow that's left for distribution. In year one, we're projecting about $250,000 in cash flow that we're going to be able to distribute to the investors. That jumps to about $350,000 in year two and all the way up to $600,000 in year three. This is not a strong cash flowing property. And what I mean by that is we are not buying this for the tremendous cash flow that it kicks out. What we are buying this property for is the upside of what we know we're going to be able to sell it for. We bought this for well under market rate, $114,000 a door. We already have a sales comp directly across the street at 155, and we're planning to exit in the low 160s in 3 years. That should be easily achievable based on the current market, based on the growth that this market is seeing, and based on the sales comps that we already have. Asset management fee is 2%. That's basically paid to Four Oaks to oversee the business plan and make sure that we are working with. Takes a tremendous amount of time for us to work with the management company to ensure that our business plan is being met and staying on top of them to ensure that we're able to deliver for you, the investor. This is an 80-20 split, which means that the LP or the passive investors will own 80% of the asset, and then the general partnership, which will oversee the entire investment, will own 20%. And you can see down here, debt service coverage ratio. That's a number that any bank is going to look at to see how strong this property performs correlated with the amount that they're lending on the property. Typically, a bank wants to see a 1.25 DSCR, debt service coverage ratio. Anything above that is very exciting to them. You can see in our first year, we're going to have a 1.39 projected DSCR, 1.44 in year two, and 1.78 in year three. Basically, what that means is the bank views this as a very, very healthy deal, which is excellent. So projected returns, we talked about this at the beginning of the presentation. A $100,000 investment is projected to yield roughly $153,000 over the 3-year hold. So I've been asked some questions that I just want to clarify. The bulk of that $53,000 return on the $100,000 investment, probably $40,000 to $45,000 of that is going to come when we sell, the proceeds from sale. There is going to be positive cash flow that will be distributed quarterly after about 6 to 12 months after closing, but the bulk of the return is going to come at the end. The way we come up with this average annual return is we take this total equity multiplier and divide it by the length of time that we've held the property. So if we had a 1.53 equity multiple and we held the property 3 years, that works out to be about a 17.7% average annual return for the total investment. IRR, again, factors in the time value of money, 15.6% annualized. And as I just said, quarterly distributions will start 6 to 12 months after closing. It takes about 3 to 6 months to really take over a property. The first 60 to 90 days are really getting to know the property on an intimate level and knowing the inner workings. After that, we're really able to kick into full gear with our CapEx disbursements and our renovations. And we really should start seeing some nice cash flow months 6 through 9 that we will be able to distribute to our investors. Cost segregation, as I mentioned earlier, it's about $25,000 in depreciation that will be passed on to the investor for every $100,000 of investment. So if you invest $50,000, you can expect about $12,500. If you were to invest $1 million, you can expect about $250,000. Again, this property, about $9,000 of the total return will come from cash flow. We are not buying this property because of the giant amount of cash flow it is going to produce. We are buying it because we are getting a tremendous value here with the cost basis that we were able to purchase it at. $44,000 will come from the proceeds from sale. That yields out $153,000 return on a $100,000 investment. The investment structure, as I mentioned earlier, 80% LP structure. That's the Class A limited partnership. That means you put your money in and you forget about it. You're not involved in the day-to-day. It's basically a silent investor, for lack of a better term. 20% to the managing members. That's Four Oaks Capital, myself, Kranti Panam, and Brian Mallon. The GP team, not only will we have 20% of ownership on the GP side, we intend to put between $1 million and $1.5 million of our own money into this asset. So we will be heavily invested on the LP side as well. And that's just basically us saying, look, we believe in this project, so we are going to put our money where our mouth is. We invest in all of our own projects. We've already talked about the returns. Minimum investment is $50,000. Maximum investment was $600,000. It's actually gone up a little bit to about $1.5 million. The timeline. All right, so tonight is the 7th. We're having this investor webinar right now. Tomorrow morning, investment will be open to funding. The way that works is soft commits will be placed. A soft commit is basically a placeholder that says, I want to invest X number of dollars into this deal. Please hold my seat at the table. We will not be asking for the funds to be wired till later towards the end of September. Once you register to invest and have and you make that soft commit, you will get what's called a PPM. That's a private placement memorandum. It will be sent out to you for e-signature. The way that works is that is a legal document that explains exactly how everything works. It's all the legal mumbo jumbo. I don't say that disparagingly, but it is very legally written. It is a legally binding contract that says, this is how much I'm investing. This is what they told me the returns were going to be. This is what they're projecting. This is their business plan. This is the structure of the investment, so on and so forth. Don't be alarmed. It is a very robust document. It's about 60 to 100 pages. So if you have questions on it, please feel free to reach out to myself, Brian, or Kranti, but that will come out tomorrow as well. September 19th is when we're asking funds to be wired with a projected closing date of September 26th. We do have the ability to extend closing 30 days if needed, but we are really hoping to get this locked up by the end of the month. So let's talk about a little bit about Four Oaks and our performance. You can see these are the current properties that we have in our portfolio. We have acquisition date and when they've sold. So in the last 6 months, Four Oaks Capital has sold 2 assets. We have another 3 pending sale. We had a 1.4 equity multiplier in just 18 months for a small asset that we had in Greenville. One of our larger assets in Augusta, or excuse me, one of our larger assets in Greenville, we had a 1.84 multiplier in 16 months. Both of those have projected average annual returns in the 17% range. We were able to deliver between 35 and 50% average annual returns on those 2 projects. We have 3 properties under contract. One we've held 26 months, one we've held 20 months, the other we've held 20 months in Augusta as well. And you'd see the equity multipliers on those are 1.7, double 2 times, and 1.75. The reason I show you this is because we are far exceeding our projections with all of these deals, and we're doing it in a much shorter fashion than what our hold dates are. Typically, our hold range that we're projecting is 3 to 5 years, but anytime we see an opportunity to return these kind of returns to our investors in this very short period of time, we're going to do that. We want to return your capital to you as quickly as possible with the largest upside possible in the shortest amount of time possible. That is how wealth building happens. The goal is we do well for you, and then you're going to be able to take that money and reinvest it in the next opportunity and keep that train rolling with essentially like compound interest with the snowball effect. We talked earlier about our recent acquisitions in Atlanta and how bullish we are on this market. So folks, I covered a lot of information. I know it's a lot. I'm sure there's some questions. We're going to open it up now for questions and go from there.
You were pretty thorough. So at the moment, we have 2 questions from Dharmendra. He asked, currently rents trail competitive properties by 500, more or less, and new leases are already being signed at our 3-year rent goal numbers. Does current owner realize this and already increasing rents potentially hurt the benefit for Four Oaks in the future?
No, not at all, because at the end of the day, we buy the property based on how we think it's going to perform. So that's actually great because we want the current owner to increase the revenues. Traditionally, as they increase the revenues, in theory, the purchase price should go up. So they're basically creating value for us right now by raising those rents, and we're not having to pay any more money or spend any money out of our pocket to do so. So that's actually a huge benefit for us that they are starting to achieve those rents, and it gives us proof of concept. We know that if they're already able to do that, it instills tremendous confidence that we're going to have no issues doing that as well. Does that answer the question?
See if Dharmendra has another comment, but he asked another question about the low flow faucets and showers.
Yes.
And how do we verify that the low flow faucets and showers haven't already been installed? And you might want to touch on why we don't install low flow toilets.
Yep, absolutely. Great question. So I know for a fact because I've spoken with the owner and they have not put in low flow. So I just know that through firsthand conversation. We do not, so we work with a water conservation company. We've done this with other properties where we've replaced everything we could make low flow. We made low flow, including toilets. That's a mistake. We don't do low flow toilets in these older assets, and I'll touch on that in just a second. But as far as we know what brands to purchase now to get the most bang for our buck while still maintaining a high level of water pressure. So we feel very confident in our ability to do that relatively inexpensively, relatively quickly, and we should see tremendous results from that in a very big way and very quickly. The reason we don't do low flow toilets is the biggest provider of low flow toilets is a company called Niagara. Their flush power is 0.9 gallons per flush with the low flow toilets. There is not enough flushing power at 0.9 gallons per flush for these 1970s pipes to handle it. So what you end up saving in water, you spend on plumbing and getting clogs removed. It just does not work well in these older pipes. Works great in modern plumbing, but it doesn't work great with 50-year-old pipes.
That is all the questions we have at the moment.
All right, folks, any other questions? Go ahead and type them in the box. And if not, we're going to go ahead and bid you farewell.
If you don't want to type them, you can just unmute yourself and throw them out there too. But otherwise, everyone will see an email tomorrow before noon through the investor portal, just alerting everyone that it is open and you can run through everything you need to do to make your commitment right in the portal. So,
right, it looks like there was one more question that just came through.
Patty asked a question about what about lead management?
About lead management?
Lead, yeah. Lead or
LEAD? Sorry, Patty, could you please elaborate?
Lead pipes.
Oh, got it. So it is not lead pipes. So that's not something we have to worry about.
And lead paint?
No lead paint. So that's another nice thing is this asset, a lot of assets that were, well, not a lot, but a decent amount of assets that were built in the late 60s and early 70s. Plumbing can be a concern and electrical can be a concern. We had all the lines scoped during due diligence and the plumbing looked great for what it is, a 50-year-old asset. And then there is no aluminum wiring. It is all copper wiring, which is a huge win.
And asbestos from Trevor.
No asbestos. Good questions, though. I can tell you, having walked through all the units we walked through, the property really is in great shape. It has excellent bones. It just needs a little lipstick. Between the landscaping and then the exterior cosmetic work that we're going to do, and then the interiors, it's going to completely change the look of this property and make it feel much more modern than the 50-year-old property that it is. So we feel extremely comfortable with that undertaking, and I know the value that that's going to add.
And then Trevor was asking about flooding. Is there any risk to flooding?
So there is a creek that runs through between the two properties. It is not in a designated flood zone, but it is right on the line where that creek runs. They have not had any floods from that creek in the 50 years that it has been in existence. But that is something that we're aware of. There is drainage in place to try there are mitigations in place for if a flood comes to try to divert the water. There are also, why am I blanking on what they're called? Like the concrete troughs that are built into the ground. So if anything did come up high, it would divert it away from the property. The property is also elevated, for the record. The flood lies, the stream lies, what would you say, Brian? Probably 6 or 7 feet below.
Yeah, and the whole other half of what is Southern Oaks 2 on to the right is a good
30 or 40 feet.
30 feet above.
Yeah. And then the original Southern Oaks is it's probably a solid, I don't know, 6 to 8 feet above the stream.
Yeah. Murphy is asking a question. Is the property already in escrow? Do you still have any pending contingencies?
Nope, our due diligence period has expired. From a risk capital standpoint, the three of us have about $500,000 invested into the property thus far. So we are fully committed and full steam ahead. Well, folks, we want to thank you guys for taking time out of your Wednesday night to join us. For those of you that are watching the recording, please feel free to reach out if you have any additional questions. And thank you for your time. Have a great evening. And we look forward to working with you. And thank you for your trust in 4 Oaks.